Well, hi, everybody. Thanks for joining us today. This is our second Fireside chat on the topic of digital asset risk. My name's Mike Versace, and I'm a research director here at Chartis Research, and I cover the digital asset risk space. I'm joined again here by my colleague Nikos, um, one of the pioneers in the digital asset risk and control market. And Nikos, maybe please a quick introduction and a little bit about your work at Metrika.
Thank you, Michael. Pleasure to be here today. I'm the founder and CEO of Metrika, and at Metrika, what we focus is on real-time risk management and compliance for digital assets, tokenization, and blockchain-based financial markets. We work with financial institutions, custodians, rating agencies, market infrastructure providers, and we help them operationalize digital asset risk across onboarding, continuous monitoring, governance, and regulatory reporting. The platform that we have built monitors thousands of key risk indicators. And I'm very excited, Michael, today for our discussion because I think this is prime time going into production.
Thanks, Nikos, and again, thanks for your work in moving this industry forward. So, just to go back a little bit on the first call you had with my colleague Sid Dash, you both spoke about why now. Why is the topic of risk relative to digital assets and the growth in those as asset classes? Why is it now time to have these discussions? And
Yeah, I think actually, even between this kind of discussion and the previous one that we had
yeah,
with Sid, I think the market has moved. What we've seen over the past 6 months, I would say, is that large financial institutions have been moving very aggressively into this space. They've been doing POCs in the past, but now we see, one only has to look at job ads where they're aggressively hiring in digital
mm,
assets, in digital asset risk, in compliance, in product, across all of the functions. Digital assets became number one, number two priority across all of the business units. Whereas before it was private credit, wealth management, AI taking the top position. So that I think is indicated of a market where they see all of the large financial institutions trying to get there because market infrastructure providers like DTCC are have a very strict timeline on tokenizing.
right.
They have publicly discussed about a soft launch in July and a hard launch in October. And Michael, I think there are some very clear use cases today that we have, like repos are very clear, collateral
Exactly.
mobility and collateral speed, freeing up liquidity. And for the first time, this is kind of what we always said that crypto, is an interesting kind of thing, and there it's its own economy, right? But there is a very clear use case here on efficiencies in the financial
Mm.
market infrastructure.
Yeah, that's great. I've seen some quotes also recently where some are actually comparing the underlying blockchain infrastructure to be as important as cloud computing and mobile networks.
It absolutely is. My very quick comment is that cloud infrastructure gave birth to software as a service,
Yep.
and blockchain is giving birth to value over the internet transferring and being able to have a financial operating system.
Great. We could talk about these things forever, Nikos. This is great. But let's talk to a couple of specific questions. We saw a lot of nodding heads, yes, but we also heard that the control structures that support risk taking and risk decisioning need to be rethought to some degree. So I'd like to ask you, what are you seeing as gaps in the way institutions think about and operationalize a suitable set of risks and controls around digital assets?
I think this is a very key question, Michael, that you're asking. I think most financial institutions understand fundamentally financial risk really, really well, right? They understand the risk categories, the risk buckets. I think they are underestimating how operationally difficult and different digital assets are.
Mm,
Traditional frameworks, assume that markets close. That's not simply the case with digital assets, right? We have always on infrastructure, we have composability between protocols and between smart contracts, and we have real-time contagion pathways. So I think the biggest gap is operationalization. Institutions, often have policies on paper, but I think they lack the continuous monitoring. And I also think another gap is, treating blockchain and digital assets as yet another asset class. It's not. It might look like that on paper, but
Mhm.
the reality is that it behaves more like a blend of financial market infrastructure, cyber systems, and cloud native technology risk. Continuous activity requires continuous controls. It's as
Yeah,
simple as that.
exactly, exactly. So now one of the things we also learned in New York a little while ago was that all three lines seem to be at the table. But I'm wondering what you're seeing in terms of these three lines of defense adopting to decentralized finance. What's the knowledge base look like relative to technical, business, and risk knowledge? And what do you think they need to do to keep pace with the innovation?
I think the first line of defense is becoming far more technical.
Mm,
Digital asset business teams now need expertise in blockchain infrastructure. They need to understand smart contracts as a concept and also the details around the smart contracts. Now, the second line, risk and compliance, I think is evolving from static policy to static policy oversight to continuous surveillance and monitoring. And the third line, the internal audit, I think it increasingly needs to be more technically fluent so that they can independently validate the blockchain controls, the node operations, the custody processes, the smart contract risks.
mm.
Institutions need professionals that kind of understand financial risk, technology risk, the classic risk kind of categories, but also understand blockchain native concepts. And I think also this is kind of very similar to how cyber risk
Mhm.
evolved from a very niche IT kind of issue into a board level discipline.
Yeah, it's a great comparison. I agree with that 100%. But at the same time, I think data and the analytics and the architecture around that is really developing into a key battleground in the market, right? Those that do it best will most likely, uh, uh, reign the best over time. So with that, what capabilities do you think are most critical? Data and analytic capabilities are most critical to allow, senior managers sort of to de-risk their participation in this market and their operation.
Yeah, the key requirement is real-time risk telemetry. That's what you
Right.
need. So you need to have visibility across not only on-chain but also off-chain, market governance, operational signals, and that includes, you need to understand validator concentration. And also, I think the challenge is not only collecting the data, but contextualizing the data into decision grade key risk indicators. That
Right.
senior management, that you can have methodologies, you can track where the data is coming from. You need those to become risk signals. What's the benchmark in terms of a good enterprise or
Mm.
of a good digital asset risk framework? So now I think we're getting in the industry some publicly available risk frameworks like the GBBC RMF,
Right.
the DTCC DASK risk framework, which are basically are accumulating the experience that these organizations have in their risk functions and are saying, from our perspective, and having run it against regulators and other financial institutions in those organizations,
Mhm.
we think that this should be kind of the bar.
Mm. Yeah, I mean, this journey, I keep thinking, Nikos, that, these are problems that we all have to solve as an industry. We saw the same processes happen of standards being developed, right? Data requirements being standardized, analytics being standardized, networks being built in a consensus way. I think we're seeing the same thing happen here. Would you agree?
I think we're seeing the exact same kind of challenge,
Yeah,
but I think there are two dimensions in this challenge that make it
right.
particularly difficult. The one dimension is the real-time nature of this, which which
Correct.
which talks about the systems, and the second dimension is that that data incorporates technology risk that traditionally your IT team and your cyber team at a financial institution, and now you're being asked as a digital asset kind of first line, stakeholder and controller to understand the risk signals and what they need to trigger in terms of severity tagged events and how to act on that. So suddenly you're getting from outside of the organization a new asset class that looks like another asset class, but with embedded technology that comes from the outside. I think to me that's kind of the challenge. These two dimensions, but you're absolutely right. They're going to go through a process where they have to go over that hump. I
Mm.
just think that hump is a little bit kind of not something that financial institutions have the inherent capabilities.
Again, one of the things we heard recently is that if digital asset risk stays outside an enterprise risk framework, it breaks governance, right? What are your thoughts on that? I know this has been a big topic for you, and you've been speaking with a number of firms about this. Just some thoughts on that, and then we'll get to a crystal ball question.
I think there are two fundamental challenges. The first is that the GRC IRM systems have not been built for continuous risk monitoring. They have
Correct.
been built based on periodic risk reporting requirements. And the second challenge is that there needs to be kind of a normalization of the data that comes from the digital asset risk domain into the enterprise risk registries that the GRC systems have. And I think we might need in the future some middleware between our
Mm.
systems that operate at, I don't know, a 600 millisecond block by block basis so that we
Mhm.
can apply real time controls to reporting, where we hear about reporting times and granularity of like an hour or a day in terms of
Mhm.
like having that data in the GRC IRM systems. These systems have mostly been built around relational databases. That's the reality of it.
Right.
Whereas our systems are being built in terms of data lakes and analytics processing and streaming data. So I think we might need some bridge in between, or we might manage to kind of find data adapters. I think we might expect some proactive financial
Mm.
institutions to say, we want to be ahead of this and we want to make sure that we manage risk all the way up in a more real time way, which
Mm.
is more suitable to this kind of asset class.
And
And, they move the needle on that.
yeah, it would seem to me that it there really isn't a choice here. To me, I mean, it must be proactive. I think traditional risk systems, the GRC or otherwise, have been searching for more continuous controls monitoring for years now, and in just I'll say the non-digital world, and it's just sort of coming to bear now. We're seeing it, but I think digitization in the financial markets has got to push this issue and push the issue over the edge, and to either these intermediary solutions or solutions that make reporting and event management as continuous as the market is.
I also think we have an opportunity because a lot of the GRC IRM systems are basically building AI capabilities into their
Right.
platforms. I think if those evolve into real time data, then AI can be a lot more effective and they can get far more efficiencies from the real time nature of the data. So I think these two trends can go together because then you get the best of both worlds. You have more visibility and more real-time visibility into the requirements of this asset class, but also you have the efficiencies of AI without taking the burden of your people being 24/7 on. And
Thank you very much, Nikos, to you and your team for your contributions, your leadership to this emerging market. It's tremendous. But before we close, sort of the last question, the crystal ball question. What do you think the next 12 to 18 months look like? Maybe specifically around some of these integration challenges, sort of the end of the game, the integration challenges that we're seeing with traditional enterprise risk and GRC systems. What do you see as the sort of big milestones you're hoping that we hit in the next 12 to 18 months?
yeah, I think in the next 12 to 18 months, the market will certainly move into production grade operationalization. It's
Right.
already moving in that direction. So I think that the large financial institutions that are already embedding tokenization and digital asset infrastructure will actually be embedding these activities into enterprise governance and the risk frameworks. We will see tighter integration with GRC and IRM platforms being requested by financial institutions. And
Mhm.
we will see much stronger expectations from regulators across continuous monitoring and evidence based risk management. We already see some of those requirements in the OCC proposed
Right.
rulemaking on the Genius Act and so on. And those that will invest in real time monitoring, automation, and integrated governance architectures, I think are going to excel. because at the end of the day, I think managing the risk around this is what financial institutions do really well at. And I think they need to master this domain so that we can officially enter from the crypto world into the digital asset world,
Right.
with somebody taking off the risk from the consumer and managing it and mitigating it and reporting it accordingly. I'm really excited about what is coming. I don't think there has been a better time in the market for digital assets and for digital asset risk and for evolving the risk infrastructure.
Very good. Excellent. Well, thanks, Nikos. Thanks as always for your insights today. And I'd like to thank everybody for listening in. And we hope to see you next time. Thanks.
Thank you for having me.